Hello everyone, welcome to this series of videos on how to trade in options. Before we get introduced ourselves to options trading, let me introduce the guest for this webinar, guest for this series of videos. I take good pride in introducing you, Mr. Vijay Kumar Tagyal. He is an engineer by education, but his passion has always been investing in stock markets, trading in stock markets. Uh, Probably for some of you, his experience equals your age. So that's how experienced he is in the stock market trading. He has been in the markets for almost about 25 years, seen the ups and downs, be it 2008 crash, be it any other crashes. Let's get started and directly hear from the man itself. Welcome, Vijay sir. Great having you on this series of webinars, and I'm excited to present this series of trading in options to my audience and probably other people who are watching this, who will watch this. To begin with, can you help me understand your experience in the stock market? How has been your journey so far? How do you define investing versus trading? What's your experience in investing versus trading?
Yeah, thank you very much, Shankar, for kind words. And it is really a pleasure to share whatever little I have learned in my 25 years of experience in the market. Like you mentioned, I have seen many ups and downs in the market. I started investing in the market in 1992. So the first activity was to invest in an initial public offering of a company called Canfin Homes. Those were the days when it was like a lottery system. You put an application. Generally, demand was more than the supply, and there is no guarantee that you will be allotted a company's share. As a consequence, what used to happen was, if you got allotment, you were sure to get a premium on listing. So this is how was the entry into the market. And then being a newspaper reader right from the childhood, when we got into a corporate job, Economic Times used to be there, and there would be some mention about the stock market. So even though we did not have money, a lot of money to invest in the market, nevertheless, variation of prices of companies and the news related to this, which would impact, or any major events in the market which will draw attention, these were drawing curiosity. And being engineers, numbers are always fascinating to people like us. And we used to hear people making big time money in this activity, which also draws natural attention to such things.
Right.
So from 1992 till about 2008, barring the brief time when Harshad Mehta's time, there was a crash in the market.
Right.
I have never seen any downsides. Side of the market was never seen, or I had not paid attention because my investment was limited in terms of time or in terms of money. But in 2006, I decided to go big time in the market, assuming that big crashes were not commonly known. But 2008 was an eye-opener. I lost 50% of my holding in this particular event. That is when I got into reading about what would you do when the market falls. Is it possible to benefit in case of a fall?
Right. So that's how your journey into derivatives started?
Yeah, in fact, what happened was during this time I was wondering, because I have always seen a return of more than 20% in the, say, 15, 16 years of initial journey in the market. And sometimes when the market was doing well, returns were even much more decent. And it is said in a lighter sense, in a bull market, everybody is a genius. So I too thought I was a genius till 2008 happened. Then after that, I saw a caption in the newspaper saying you can make money in a falling market.
Mm-hmm.
That caught my attention.
Mm-hmm.
And then I pursued that, and then I did attend some programs and workshops in derivatives where they show you a possibility of making money in a falling market.
Right.
And unfortunately, after getting this awareness that it is possible to make money in a falling market, I did not make enough money, or I did not. I made more losses than profits. But then I
Mm-hmm.
don't blame it on the science. I blame it on the practice.
Mm-hmm. Very interesting. Lot more psychological thoughts there. Coming back straight away to options trading, which is the topic that we are discussing in the series of videos that we are thinking of. How do you think are trading in options different from cash equity trading or futures trading? And basically, what are options?
Can I use a slide? Actually, would that help?
Please go ahead, sir. Yeah.
1 second. Do you see this slide?
Yes.
Okay. How option is different from future?
But first of all, what are
Because
options?
okay, option is a type of a derivative. So for those of you who may be familiar with the word derivative, it may not need an explanation. But again, for not minding for repeating what is obvious. So derivative is something which derives its value based on something else. Again, to give a layman's example, let us say butter.
Mm-hmm.
Butter is a derivative of milk.
Right.
So value of butter will be determined based on the value of milk.
Mm-hmm.
Does that explain?
Yeah, very much.
Okay. And going further, futures, okay, is one option, one alternative in the stock market, where you have stock-based futures and index-based futures. So future linearly maps the underlying. For example, if you have a stock like Infosys futures will be tracking Infosys stock price. So the underlying is the stock, future is deriving its value based on the underlying. If Infosys value increases by say 100 rupees, the future value of Infosys derivative is likely to be varying by a factor of 100 or very close to that. In case of an option, it is a
I think there is a small connection issue, but however, we should get Vijay sir back soon. Yes, sir, please go ahead. I think there was some technical glitch, but we are live again.
Yeah. So to repeat the first few advantages about option is low initial investment,
Mm-hmm.
which means limited loss.
Mm-hmm.
Even if you have to lose the entire initial investment, nothing major happens to you.
Can you make it full screen, sir?
Yeah, I'll do that. Can you see it better now?
Perfect.
Okay. So yeah, again, low investment, which means loss is capped, and maximum profit is unlimited. This is the best advantage about an option.
Mm-hmm.
And the disadvantage is it's a very complex instrument to understand.
Mm-hmm.
To compare with again futures, what we discussed, future price variations are linear, whereas option price variations are non-linear. And I am told human brain does not understand non-linear variations easily. So that's the biggest disadvantage as far as the option is concerned. But if you are willing to understand non-linearity and then persist with this instrument, it's a great opportunity to understand, operate, and make money in the market.
Awesome. That's a great news. So I wanted to ask you a very personal straight question.
Yeah.
Have you got success in trading in options yourself?
I'll say it's a mixed success.
Okay.
So, but see, what happens is discipline is one one aspect of trading, which requires a lot of practice.
Okay.
So,
Got it. So I remember you saying you have won 2-0 the 60-day challenge. Was that on
that is true.
options?
That is true.
Okay. Okay.
Yeah, trading purely in options for 2 consecutive quarters. I won the 60-day challenge.
Awesome. I think you should share that in the next video, because trust me, sir, I've been speaking to so many people and I know how difficult it is to be in a profitable situation, even if it is 1 rupee. You know how cheating our minds are, our situations are, and then we either overtrade, undertrade, take a lot of wrong trades, and typically we end up in making losses. And that's also one of the reason why Zerodha is keeping on their 60-day challenge, because they know that not many people will be in a profitable position after 60 days. That's a good news.
Yeah.
That makes it all the more promising to learn from you the trading methodology in options. Cool. I'm all ears to learn more on options, and please help us understand options in a little more detail.
No, one more aspect I'd like to emphasize here is, I believe there's a story about Japanese or Chinese bamboo.
No, sir, I haven't heard of it.
Okay, so there's a story which goes like this. Somebody had planted, I don't know, the seed or a small sapling of a Chinese bamboo. So he was asked to water this every day. And he used to water this, and then for 5 years, there's not even half an inch of growth. So after 5 years, what happened was, anyway, this person who was told to water this very meticulously and very religiously, he continued to water for 5 years. After the 5th year, I believe it started growing an inch every week or every month.
Okay.
And the growth was so phenomenal. So 5 years of persisting effort without seeing a return was something, okay, this gentleman undertook. And after 5 years, the returns were so huge. See, like, had he given up after, say, 4.5 years,
then his 4.5 years. No, then his 4.5 years risk would have gone waste. His time and money that he has, energy that he has spent for 4.5 years would have gone waste.
Exactly. So
now and what is happening is, barred from a huge return that he would have got after 5 years.
Exactly. So this is the key here. Even though the profit potential looks so huge, I would caution everybody who wants to even get introduced to options, saying it's just a very, very disciplined game. And I always say very loudly that discipline is in very, very short supply.
Okay, so it applies
to me, it applies to everybody around us.
I have a follow-up question on that, which is, if you if you commit yourself; 2, if you are disciplined enough; 3, if you follow the money management rules properly; 4, if you understand options correctly and trade correctly. Is there a possibility that we can increase our probability of success in options trading?
Well, there's no doubt about giving an affirmative answer to that. But you're saying, if there are so many ifs you have used.
Yeah, I'm saying, I mean, see, I want success, and if I want success, I will commit to myself. 2, I will commit to my discipline because I want success. And I don't know if there was an article that I wrote on my LinkedIn, which is discipline equal to freedom, which means if I am disciplined enough to go to gym every day, I am freed of all the diseases. If likewise, I'm seeing some relation here. If I am disciplined enough, then there is possibility that I increase my odds of success. And if that is the case, why not I be more disciplined? I understand it is in short supply, because that is coming from a 25 years experience person like you. But then my requirement is success, and I will do whatever that it takes for me to be successful. Okay, we will. I think we will touch upon the softer parts later, and I would like to know more about the options. And probably you can go to the next slide and enlighten us.
Okay, see, option, there are parameters you need to understand, but prior to that, option, like a future, is a contract between the buyer and the seller.
Okay.
So, and underlying for an option is either a stock or an index.
Okay.
So let us take Nifty for the sake of simplicity, that we are considering options in index, which is Nifty, which most of the market participants understand.
Mm-hmm.
So Nifty is spot value, is the underlying.
All right.
So based on this, see, we know the Nifty spot price keeps changing during the market hours.
Right, sir. Go ahead.
So this slide was prepared some time back. So for the sake of understanding, let us assume current value of Nifty is 8,300. Now we introduce one more parameter of option, which is called the strike price. So I'd like to explain this by saying it's the expected price which a buyer of an option has in mind. So the strike price of an option does not change during the market hours. So let us say current value for Nifty is 8,300.
Okay, go ahead, sir.
$8,100, $8,150. So this is a 50 count price interval. And option contract has an expiry date, like all other derivative contracts in the cash segment and in the equity segment. Last Thursday of the month is the expiry date. So I have taken dates from 2015. So 30th April, 28th May, 25th June. And we shall discuss only current month contracts. We don't discuss either the next month or the far month contracts. So for the sake of simplicity, let us stick to dates in this particular slide. Say spot price is 6,140 and strike price is 6,200. Expiry date is 28 October 2010. Lot size 50. Type of option is a call. Premium is amount paid by the buyer. Example, rupees 100. And the contract description looks like option, index, Nifty, the strike price, call, 28th October 2010. Any questions, Shankar? Because a lot of new terminology introduced.
I think I'm good because I am excited to know all of this, and this is good so far. We can probably in the next video we can take a live example and show us.
Okay, great. Let us move forward. Now what happens next? If spot price moves closer to 6,200, the premium value increases, which means 100 becomes 125. The difference between the buy premium and the sell premium is the profit. So if 50 is the lot size, 50 into 125 minus 100 is equal to 1,250. The investment was 5,000 rupees and profit is 1,250.
Got it.
On percentage terms, this is really, really huge.
Okay.
So this is where it is very scary, because I don't want people to be carried away saying there's such a huge profit potential is there. But the downside is if the value loses by the similar count, so you end up making a huge percentage loss as well.
Right.
Going further into the terminology, you have call options and you have put options. So call option is similar to a buy position in futures, which means you are long, you expect the price to increase, and you have a put option when the price is expected to decline. One beautiful advantage of option is you don't need to short at all. Even when the market falls, you have choice of buying first and selling later, which I don't think you have any equivalent instrument. Even if you do intraday stock trading, if you sell first, if there's a movement in the other direction, you are exposing yourself to unlimited risk.
Right.
In case of an option, even when the price is falling, you have an instrument which is known as a put option, where you buy, which means your investment is limited and your reward is unlimited. Does that
Got
sound
it.
exciting, Shankar?
Very much. And if I am somebody who understands futures, I will look at call option as similar to buying position in futures, and put option as something like selling a position in futures. The other understanding that I am getting from this particular slide is that I will take a call option when I am expecting that the price is going to increase, and I will take a put
Yes.
option when I'm expecting that the price is going to decrease. Awesome.
Yeah.
I'm good with this. We can continue.
So to reinstate what I said about the put option, even though it is similar to sell position in futures, your risk is exceedingly lower compared to taking a sell position in the future.
Got it.
Do you get that?
I
There's a huge advantage.
I have a follow-up question on that, but I will take it up in the next video.
Sure. So now let us look at the order flow, how a call option works.
Mm-hmm.
You will buy a call option after paying a premium. Let us assume price changes in the desired direction. You sell the call option for a higher premium and hence a profit is made. If price changes in the undesired direction, sell the option for a lower premium and hence a loss results.
Go ahead,
you could
sir.
protect yourself by whatever stop loss of strategies you would have. And order flow for a put option, you expect the price to go down. You buy a put option after paying the premium. Price changes in the desired direction. You sell the put option for a higher premium and hence a profit is made. If price changes in the undesired direction, you sell the option for a lower premium and hence a loss results. Are you clear?
Yes, sir. I am very much with you.
Essentially, the premium that you are paying is going to vary in a non-linear fashion depending on the underlying price variation.
Got it.
That is the key. Okay, so beyond this, it gets very, very technical and very, very complex. It requires very committed participants to move forward. So I think this was a good introduction to whatever this option, this animal on the in the stock market zoo. So if you're interested in getting further information from me, my email address is listed and my phone number is there, and I'd be happy to share my experience and my learnings with the interested people.
Thank you. That was a wonderful introduction to options. Good to know from somebody who has been there, done that. And I'm looking forward to you participating in the other videos which is follow-up of these videos. And I look forward to more participants coming and seeing this video. And please do not forget to share this with other people who might benefit from this. Thank you. And look forward
My pleasure,
to you.
Shankar.
Thank
My
you,
real
sir.
pleasure interacting with you.
Thank you, sir. Bye.